Good evening and welcome back to Stock Daily. It is Monday, September 8th, 2025, here on the U.S. East Coast, and we're recording this at 8:25 p.m. Tonight's program takes a sweeping look at the markets from the U.S. session and global headlines to the specific names investors cannot ignore. It's one of those nights where calm on the surface belies turbulence below, and the market's subtle moves demand attention. With back-to-back economic triggers, CPI, PPI, and a highly anticipated employment revision, alongside a flurry of corporate developments, what appears uneventful may prove laden with both risk and opportunity. The four major U.S. indexes ended modestly higher, but the advance wasn't broad-based. The S&P 500 finished in the green on the back of mega-cap leadership, while the equal-weight version lagged, a reminder that breadth remains weak. More stocks declined than advanced on the NYSE. The Russell 2000 clawed back intraday losses yet still looks fragile, a continuation of 2025's theme. Leadership concentrated in a handful of giants, while the average stock struggles to keep pace. The Dow recovered with help from healthcare defensives, and the Nasdaq reflected the ongoing tug-of-war between AI enthusiasm and justifiable concerns over stretched valuations. If you glance at closing prices alone, you might see stability. The internals say otherwise, and narrow leadership has a way of faltering when macro surprises land. This week's macro story centers on inflation and employment. August CPI lands midweek, followed by PPI. Headline CPI is expected to tick higher on energy's rebound, while core inflation remains sticky. The Federal Reserve has signaled a willingness to cut before year-end, and September is widely expected to bring a 25 basis point reduction. Futures markets are effectively pricing that with 100% certainty and even leave roughly a 10% chance for a 50-point cut, but a hotter-than-expected CPI would erase that larger cut scenario quickly. The more consequential moment may arrive sooner when the Bureau of Labor Statistics publishes its annual employment revision. The adjustment covers data through March and could reveal that the economy created substantially fewer jobs than initially reported. Early estimates point to a downward revision on the order of 800,000 jobs, about 67,000 fewer per month, and some on the street, including Nomura and RBC, have warned the figure could approach 1 million. If realized, that would validate what many households already feel. The labor market has softened more than the headline print suggested. Markets would likely respond by strengthening the case for faster easing and by pulling long-end yields lower, even as equity investors grapple with the knock-on risk to consumer spending, the backbone of GDP growth. Today's New York Fed Consumer Expectations Survey reinforced the caution. Short-term inflation expectations nudged higher, long-term expectations held flat, but job insecurity worsened meaningfully. The perceived probability of losing a job in the next year climbed to the highest since the survey began, and the probability of finding a job if one is lost fell to roughly 45%, an all-time low for the series. Companies may feel less wage pressure in that environment, but consumers tend to curb discretionary spending when they doubt their ability to replace income. That mix, a softer labor undercurrent meeting still sticky prices, is exactly the kind of tension that makes markets hypersensitive to each data point. Turning to stocks that are commanding attention, the mechanical but powerful force of index inclusion is front and center. As the S&P 500 rebalances heading into September 22nd, names tied to that inclusion trade have been volatile. Apple remains a focal point ahead of its hardware event, and because passive funds mechanically accumulate into benchmark changes, the stock opened with a gap toward $537 on expectations of forced buying, but surrendered a chunk of that pop as the day matured. On valuation, Apple is at the upper bound of its justified range. Using forward earnings, a 30 to 40x multiple implies a fair value band of roughly $265 to $358 for 2025 and about $405 to $540 for 2026. With shares changing hands near $547, the market is already assuming the high end of growth. That doesn't preclude upside if the iPhone cycle or services outperforms, but it narrows the margin of safety and shifts the calculus for long-term entries toward pullback zones in the 360 to 400 range, roughly aligned with the 200-day moving average, where stronger hands often wait. MicroStrategy sits at the other end of the spectrum. Although it has software roots, the equity now behaves like a leveraged Bitcoin vehicle, which helps explain why it was passed over in index editions. Traditional valuation work has limited meaning here. Price largely keys off crypto. Technically, $318 is the must-hold shelf. Lose that, and the air pocket down toward $178 opens quickly. For traders, the message is simple. If you play it with risk controls first. Brokerages are a live barometer of risk appetite, and their cyclicality cuts both ways. Trend-heavy markets deliver volume, order flow, and high transaction revenue. Choppy sideways tapes do the opposite. That is why their multiples compress and expand so violently. Analysts often call it a double Davis setup, where falling earnings meet multiple contraction at the same time. The near-term map shows support down near the 97-101 zone, but if the broader tape corrects by 12 to 15%, the path to roughly 80 is not far-fetched. Historically, the most compelling long entries in brokers have come when fear overwhelms, not when the cycle is peaking, which argues for patience while the macro data resolves. Nvidia continues to draw the market's eye. Reports suggest its H20 data center chips have secured the green lights needed to serve major Chinese customers, a swing factor that could mean $20 to $50 billion of incremental revenue depending on shipment authorizations and timing. Yet even a dominant fundamental story can stall tactically if the chart demands respect. The stock broke below $169 recently and sketched a compact head and shoulders look, which telegraphs near-term risk toward $156 to $159, and on overshoot, perhaps $149. At the same time, Nvidia remains a favorite for long-only funds, and the depth of latent dip-buying interest makes it a treacherous short. Unless a policy or demand shock intervenes, pullbacks tend to be bought, and the bigger picture thesis, AI infrastructure still in early innings, stays intact. UnitedHealth has been doing the steady work of holding guidance together in a complicated cost environment. Management has reaffirmed at least $26 in earnings per share for the fiscal year. For the stock, $323 is the battleground. If price can break and hold above that level, it clears overhead supply left by investors who bought higher and opens room toward $365 to $403 where longer-term resistance sits. If instead the tape rolls and the stock slips under $280, the probability of renewed selling pressure rises. In managed care, medical cost trend and premium pricing always pull in opposite directions. In this tape, technical levels amplify that push-pull. Tesla, meanwhile, remains range-bound and honest about it. The lower rail sits near $314 and the upper band around $380, with $348 a key mid-range tell. Options open interest has clustered up around $380, turning that level into a soft magnet. But until there's a decisive break, patience is a strategy, not a sin. Momentum traders will want to buy strength through resistance or fade weakness to support. Anything in the mushy middle risks churn. Beyond those first-line names, several other heavyweights and headline grabbers deserve airtime. Microsoft's enterprise AI positioning continues to firm up as Azure's AI compute bookings accelerate. The stock has been trading around 25 to 30x forward earnings, with a working fair value corridor around $370 to $450 based on current cloud growth in the high teens year over year. Should AI workload ramps persist into calendar 2026, the top end of that band is plausible. Should macro growth wobble, the multiple shrinks before the story does. Amazon is making noise again where it matters. Free cash flow and AWS margins. A $30 billion buyback and stronger than expected cloud profitability lit a fire under the equity, which has been carrying a roughly 40-45x forward multiple. Expensive for retail, reasonable for a cloud business growing in the low 20s. On the chart, the $155 area is a level to watch for pullbacks, while a clean extension through $180 would confirm that buyers are leaning into the growth reacceleration narrative. Meta has returned to favor as AI-powered ad formats push engagement and conversion higher. With shares moving on renewed confidence in monetization across Facebook, Instagram, and Reels, investors have been underwriting a forward valuation near 20 to 25x operating income and penciling in a fair value envelope in the $500 to $600 region if execution holds. The wild card, as always in ad land, is the macro ad budget cycle. Signs of consumer strain can ripple into ad spending remarkably fast. Alphabet put a legal overhang in the rear view with a favorable turn in its antitrust saga, requiring some data sharing changes in Chrome while leaving the core ecosystem intact. That combination was enough to reset sentiment around search durability. At roughly 30x forward earnings and with an improving expense discipline, the equity can justify a step up toward the upper 130s on valuation alone, with AI monetization optionality on top. Broadcom's AI adjacency remains the quiet compounder in the semi-stack. Strong guidance color on an AI accelerator collaboration slated for as early as 2026 bolstered the stock, which trades in the high 30s to low 40s forward PE range. If that pipeline converts into shipments at anything close to current hopes, earnings power has mid-single-digit upside beyond baseline, with the multiple doing less work than the cash flow. Retail has generated its own cross-currents. Macy's printed its first same-store sales growth since 2022, a not insignificant signal for department stores, and the stock responded with a surge north of 20% as investors reconsidered the turnaround's credibility. American Eagle went vertical on pop culture buzz that translated into traffic and sell-through, reminding the market that brand heat still matters when inventory is clean. Lululemon provided the cautionary counterpoint, lowering sales forecasts and dropping more than 15% in a single session as the market repriced margin durability. Staples such as Kellogg's and Kimberly-Clark have tried to steady the ship, talking down cost pressure in key categories and leaning on high teens forward PE safety when investors reach for ballast. In the banks, the message is mixed. JP Morgan's beat came with softer trading revenue, and Bank of America noted a modest uptick in card delinquencies, the kind of early cycle tremor that rarely matters on its own, but can matter a lot if it becomes a pattern. With both trading around 10 to 12x forward earnings, the valuation side does not scream danger. The credit trend side begs monitoring if the labor revision paints a weaker household picture. Outside the U.S., government bond markets have been saying the quiet part out loud. Japanese 30-year yields have pressed to records without historical guideposts for fair value. In the UK, 20 and 30-year gilts have revisited late 1990s levels. In the US, the 30-year briefly tagged 5% before easing. That trio spells a regime where discount rates are still recalibrating higher than the past decade's norms, and equity multiples must flex to that reality. Emerging markets have held a cautiously constructive line on the hope that U.S. cuts will weaken the dollar and relieve pressure, but currency and local rate sensitivity remain high, particularly across Latin America, where any renewed dollar strength can pull financing conditions forward in a hurry. Semiconductor supply chains beyond the marquee AI names deserve watch lists too. Analog and memory orders have begun to show tentative improvement in pockets, an early cycle tell that broader compute demand may be stabilizing underneath the hyperscaler wave. If that stabilizes into Q4, the semi-complex could see breadth broaden beyond the top 2 or 3 tickers that have dominated the narrative. Housing and autos, perennially sensitive to rates, stand to benefit the most if the employment revision tilts the market decisively toward faster cuts. Homebuilder shares already sniffed that out today, rallying as much as 3% on the prospect of lower mortgage rates into the winter selling season. Auto affordability remains tough, but a few tenths lower on financing can stimulate demand at the margin, particularly for models with better inventory availability and incentives. Currencies add another layer to the setup. A softer dollar on the back of weaker labor and easier Fed rhetoric would typically buoy commodities and non-U.S. equities. A sticky CPI that nudges yields higher would stiffen the dollar and retighten global financial conditions. The path of least resistance for multi-asset portfolios right now involves keeping some dollar hedge optionality in the mix, while letting the macro decide whether to lean into EM or tuck back into U.S. defensives. History offers useful analogs, not perfect maps. Late cycle stretches in the late 1990s and the post-GFC recoveries featured weeks where a single surprise, on jobs, on inflation, on policy, flipped leadership overnight, from growth to value to defensives and back again. We're in that kind of week. If the labor revision removes close to 1 million jobs from the ledger and CPI behaves, cuts get pulled forward, long yields ease, housing and autos catch a bid, and the market can broaden beyond the narrowest leadership. If CPI runs hot while labor softens, stagflation risk intrudes and defensives like healthcare, staples, and utilities should find sponsorship while high multiple growth wobbles. If the revision is milder and inflation is benign, the status quo persists. AI-led megacaps remain the center of gravity while cyclicals bide their time. What makes tonight interesting is not that the tape was quiet, it's that the quiet contains so many possible futures. Apple is priced for excellence and will need to deliver. Nvidia's long arc is intact even as the near-term chart asks for respect. MicroStrategy is a leveraged macro bet, dressed as an equity, and should be handled accordingly. Brokers are telling you that participation is inconsistent. UnitedHealth is at a pivotal shelf where execution meets sentiment. Tesla's range keeps paying the patient. Microsoft, Amazon, Meta, Alphabet, and Broadcom continue to define the AI and cloud cash flow spine that holds the market together. Macy's, American Eagle, and Lululemon collectively remind you that retail is a stock picker's sector again. The banks are fine on earnings and twitchy on credit. Global bonds are repricing the decade, and the dollar will follow whichever macro story wins this week. So while today looked uneventful, the setup is anything but. Breadth is narrow, consumer confidence is softening, and major data is inbound. The calm you saw today is unlikely to last through the prints. If you found value in tonight's long-form breakdown, tap like, drop a comment with the tickers you want covered next, and share this with someone who trades the data. I'll be here tomorrow evening to make sense of whatever the labor revision and inflation do to the tape, and to map out how policy, positioning, and price action will shape the next leg.